Stop right there. I know what you're thinking. Crypto taxes for 2026? It's only 2025! Why are we talking about this now? Because if you wait until next April, you are going to be in a world of pain. I'm telling you this as a friend, someone who has seen the absolute nightmare scenarios unfold. This isn't just some dry, boring tax lecture. This is urgent, vital information that could save you thousands of dollars, countless hours of stress, and frankly, keep you out of serious trouble with the IRS. Here is the reality. The IRS is not playing around anymore. They have been investing heavily in tracking crypto transactions, and with the regulatory landscape evolving faster than ever, particularly with new rules coming into full effect, your 2025 tax year, which you'll be reporting in early 2026, is going to be the year they truly crack down. If you think your crypto activities on platforms like Coinbase or Robinhood are invisible, let me disabuse you of that dangerous notion right now. They know. The government knows, and pretending otherwise is a recipe for disaster. I want to save you from that nightmare. So let's deep dive into exactly what you need to know to navigate the crypto tax guide for 2026, focusing specifically on your gains from Coinbase and Robinhood. This isn't just about reporting, it's about understanding, planning, and protecting yourself. Let's start with the absolute biggest misconception, the one that keeps people up at night, or worse, leads them into complacency. The IRS doesn't really know about my crypto. It's decentralized, right? Anonymous? Stop right there. That is profoundly, catastrophically wrong, especially when we're talking about centralized exchanges like Coinbase and Robinhood. These platforms are regulated financial institutions, at least for their U.S. operations. They have Know Your Customer (KYC) and anti-money laundering (AML) policies. They collect your social security number, your address, your identity. They are legally obligated to report certain activities to the IRS. Imagine you're sitting there, feeling smug because you made a few $1,000s trading Dogecoin on Robinhood or buying Ethereum on Coinbase, and you think, well, I just transferred it to my cold wallet, so it's off the grid. Here's the consequence of that thinking. The moment you sell crypto for fiat currency like US dollars, or in many cases, even trade crypto for another crypto, that exchange has a record. And if you meet certain thresholds, they will send a Form 1099-B or 1099 MISC to both you and the IRS. The IRS isn't guessing, they have your data. If you don't report it, it's not a misunderstanding, it's a discrepancy, and that triggers flags. The solution? Proactive, accurate reporting. There is no hiding. There is only understanding the rules and playing by them. So what exactly is taxable when it comes to crypto? This is where many people get tripped up. It's not just selling your Bitcoin for cash. Let me explain why this matters. The IRS views cryptocurrency as property for tax purposes, similar to stocks or real estate. This single classification has massive implications. First, obviously, selling crypto for fiat currency like USD is a taxable event. You made a profit? That's a capital gain. You lost money? That's a capital loss. Simple enough. But here's where it gets tricky, and where Coinbase and Robinhood users often make critical errors. Trading one cryptocurrency for another is also a taxable event. Yes, you heard me correctly. If you used your Bitcoin to buy Ethereum, that's considered a disposition of your Bitcoin, and you've realized a gain or loss on that Bitcoin. Then, your cost basis for the Ethereum you just acquired is the fair market value of the Ethereum at the time of the trade. Imagine you bought one BTC for $10,000. Later, when BTC is at $30,000, you use that one BTC to buy 15 ETH. You just realized a $20,000 capital gain on your Bitcoin, even though you never touched a single dollar bill. Many people make this mistake, thinking, I just swapped coins, no cash involved, no tax. The consequence? They fail to report these crypto-to-crypto trades, leading to massive underreporting of income and an incorrect cost basis for their subsequent crypto holdings. When they eventually sell that ETH for USD, their records are completely messed up, and they'll either overpay or, more likely, underpay and face penalties. The solution? Track every single transaction, every swap, every trade. This isn't just a suggestion, it's a necessity. Let's talk about cost basis, because this is the fundamental bedrock of your entire crypto tax report. Without understanding this, everything else falls apart. Your cost basis is essentially what you paid for an asset, including any fees, plus any other costs incurred to acquire it. It's the starting point for calculating your gain or loss. If you bought one ETH for $1,000, your cost basis is $1,000 in. If you sell it for $3,000, your gain is $2,000. Simple, right? Not always. A common misconception is that your exchange, like Coinbase or Robinhood, will perfectly calculate your cost basis for you across all your activities. While they do a decent job for direct fiat purchases and sales, they often fall short when you're moving crypto between different exchanges, or buying crypto with other crypto, or engaging in more complex DeFi activities. Imagine you've been dollar cost averaging into Bitcoin for years, buying small amounts every week. Then you transfer some of that Bitcoin from Coinbase to a separate wallet, then to another exchange, and then you trade it for an altcoin. How do you know which specific Bitcoin you just sold? Was it the one you bought at $5,000 or the one you bought at $60,000? The consequence of getting this wrong is either paying too much tax because you used a higher cost basis than allowed, or paying too little and getting flagged for an audit. The solution involves choosing an accounting method, first in, first out FIFO, last in, first out LIFO, or specific identification. FIFO assumes you sell your oldest crypto first. LIFO assumes you sell your newest crypto first. Specific identification allows you to choose which specific lot of crypto you're selling, often the most tax-efficient method, but requires meticulous record-keeping. Most tax software will help you apply these, but you need to understand the underlying principle. This is why tracking software is not optional. It's mandatory for anyone serious about crypto. Now let's dive into a crucial distinction that can significantly impact your tax bill: short-term versus long-term capital gains. This is where strategic planning comes into play. The rule is straightforward. If you held a cryptocurrency for 1 year or less before selling it, any profit you make is considered a short-term capital gain. This is taxed at your ordinary income tax rates, which can be as high as 37% for top earners. However, if you held that same cryptocurrency for more than 1 year before selling it, any profit is considered a long-term capital gain. Long-term capital gains are taxed at much lower preferential rates, typically 0%, 15%, or 20%, depending on your income level. Let me explain why this matters. Imagine you bought Bitcoin in January 2025 and it surged in value. If you sell it in March 2025, that gain is short-term, potentially taxed at 25% or 30%. But if you held on to that same Bitcoin until March 2026 and then sold it, that gain could be taxed at 15% or even 0% if your income is low enough. The consequence of not understanding this distinction is leaving significant money on the table. You could be paying thousands more in taxes than necessary simply because you sold a few weeks or months too early. The common misconception is that it's all just capital gains. Who cares about the holding period? No, it's not all the same. The solution? Be mindful of your holding periods. If you're close to that 1 year mark, consider holding just a little longer if it makes financial sense for your overall strategy. This isn't just about avoiding penalties. It's about optimizing your tax burden legally and intelligently. Let's get specific about reporting from the big players. Coinbase. For many years, Coinbase has been a primary gateway into crypto, and they do report to the IRS, but not always in the comprehensive way you might expect. A common misconception is that Coinbase sends you a single, perfectly complete tax form that covers everything you need. Here's the reality. Coinbase primarily issues Form 1099 MESC for specific types of income, like staking rewards or referral bonuses if you meet certain thresholds. More importantly, for capital gains and losses, they might issue a Form 1099-B, but only if you meet certain criteria, such as having over $20,000 in gross proceeds and more than 200 transactions in a given year, or if you reside in a state that has specific lower reporting thresholds. Even if you receive a 1099-B from Coinbase, it often only covers transactions where you sold crypto for fiat currency. It typically does not include your crypto-to-crypto trades, which, as we discussed, are also taxable events. Imagine you've been actively trading on Coinbase, swapping BTC for ETH and ETH for SOL, then selling a small amount of SOL for USD. You only get a 1099 MISC for a few dollars of staking rewards. You might mistakenly think, "Oh, I'm good, nothing else to report." The consequence? You've underreported all those crypto-to-crypto gains, and the IRS will see that you received a 1099 MISC but zero capital gains from crypto. That's a huge red flag. The solution? You cannot rely solely on the forms Coinbase sends you. You must download your complete transaction history from Coinbase, which is typically available as a CSV file. This file contains every single buy, sell, trade, send, and receive. This raw data is what you feed into a crypto tax software, which will then generate the accurate forms you need. Now let's talk about Robinhood. Robinhood, known for its user-friendly interface and integrated crypto and stock trading, presents its own set of nuances. Because Robinhood started as a stock trading platform, its crypto reporting often mirrors its stock reporting, primarily through Form 1099-B. This form details your proceeds from sales and your cost basis. A common misconception is that because Robinhood integrates crypto so seamlessly with stocks, the tax implications are somehow simpler or more forgiving. Here's why that's not entirely true. While Robinhood is generally better at providing a 1099-B that includes your crypto sales for fiat, it still faces the same challenges as other exchanges when it comes to complex scenarios. For example, if you bought DAB.UE on Robinhood, sold it, and then immediately used the proceeds to buy TSLA stock, Robinhood will report the sale of .D on your 1099-B. However, verifying the accuracy of the cost basis, especially if you had transferred crypto into Robinhood or engaged in very rapid complex trades, still falls on you. The consequence of not double-checking your Robinhood 1099-B is that you might assume the cost basis provided is always perfectly accurate, when there might be edge cases or specific transactions where it isn't. The solution, just like with Coinbase, download your transaction history from Robinhood, cross-reference it with the 1099-B they provide. Use a crypto tax software to import both and verify the calculations. Don't blindly trust any single form, no matter how reputable the platform. This is your financial responsibility. This brings us to the absolutely critical tool you need, crypto tax tracking software. I cannot stress this enough. If you are involved in crypto beyond a single, small buy and hold on one exchange, manual tracking is not just difficult, it's practically impossible and highly prone to error. A common misconception is that you can just use a simple spreadsheet to track everything. Let me explain why this matters. Imagine you are an active crypto user. You have an account on Coinbase, another on Robinhood, maybe a few assets on Binance.us. You use MetaMask for DeFi protocols. You've dabbled in NFTs on OpenSea. You've received a few airdrops and perhaps you're staking some ETH. If you try to manually track every single buy, sell, trade, swap, transfer, gas fee, reward, and airdrop across all these platforms and wallets, you will spend hundreds of hours, you will make mistakes, and you will likely miss crucial taxable events. The consequence of attempting this spreadsheet nightmare is immense frustration, inaccurate reporting, and potentially missing out on legitimate deductions or underreporting income, leading to an IRS audit. The solution is to invest in a reputable crypto tax software like Coinly, CoinTracker, TaxBit, or Accounting. These services are designed to integrate with hundreds of exchanges, wallets, and blockchain protocols. You connect your accounts, import your CSVs, and the software automatically pulls in your transactions, calculates your cost basis using your chosen method, FIFO, LEFO, etc., identifies taxable events, and generates comprehensive tax reports like Form 8949 and Schedule D, ready for your tax preparer or for you to input into your preferred tax filing software. This isn't an upsell, it's a necessity for anyone serious about navigating crypto taxes accurately and efficiently. This software literally pays for itself in peace of mind and potential tax savings. What if you're sitting there right now, feeling a cold dread because you realize you've made mistakes in previous years? Perhaps you didn't report your 2021 or 2022 crypto gains, or you completely missed those crypto-to-crypto trades. A common misconception is that it's too late, that the IRS will surely catch you and there's nothing you can do. Stop right there. That's not entirely true, and letting that fear paralyze you is the worst possible course of action. The consequence of doing nothing is that if the IRS eventually catches the discrepancy, the penalties can be severe. Hefty fines, interest on unpaid taxes, and in egregious cases of willful evasion, even criminal charges. The solution? You can file an amended tax return. This means going back to the years you made mistakes, correcting your crypto reporting, and refiling your tax forms. If you owe additional tax, you'll also pay that, along with any accrued interest. While it's not ideal, filing an amended return and voluntarily correcting your past errors is almost always better than waiting for the IRS to come knocking. For very significant unreported income over multiple years, there are even voluntary disclosure programs, where you proactively come clean in exchange for potentially reduced penalties. This is not something you should attempt alone. You absolutely need to consult with a qualified tax professional who specializes in crypto. They can guide you through the process, assess your risk, and help you determine the best course of action. It's never too late to make things right, but the sooner you act, the better your outcome will likely be. Let's talk about the silver lining, because it's not all doom and gloom. Capital losses. Many people assume that if their crypto portfolio took a hit, those losses are just unfortunate and have no tax benefit. This is another misconception that can cost you money. Here's why it matters. Capital losses are incredibly valuable for tax purposes. If you sell a cryptocurrency for less than your cost basis, you have a capital loss. The solution? You can use those capital losses to offset any capital gains you have. For example, if you made $10,000 in gains from selling Bitcoin but lost $7,000 on Solana, you only have to pay tax on the net $3,000 gain. Even better, if your capital losses exceed your capital gains, you can use up to $3,000 of those net losses to offset your ordinary income each year. And if you have more than $3,000 in net capital losses, you can carry forward the remainder indefinitely to offset future capital gains or ordinary income. This strategy is known as tax loss harvesting. Imagine you're nearing the end of the tax year 2025 and you have some significant gains, but also some assets that are deeply in the red. You could strategically sell those losing assets before December 31st to realize the losses, which you can then use to reduce your overall tax liability. The consequence of not understanding this is paying more tax than you legally need to. The solution is to be aware of your portfolio's performance. If you have losing positions, consider realizing those losses strategically, especially towards the end of the year. Again, crypto tax software will help you identify these opportunities. Finally, let's briefly touch on the evolving landscape beyond simple buys and sells on Coinbase and Robinhood. We're talking about DeFi, NFTs, staking, and airdrops. These are rapidly growing areas, and they introduce even more complexity. A common misconception is that because these activities are often on decentralized platforms or involve novel technologies, they are somehow untraceable or tax-exempt. Here's the reality. The IRS considers virtually all forms of income or value received in crypto to be taxable. Staking rewards? Taxable income at the fair market value when you receive them. Airdrops? Also taxable income at the fair market value when you gain dominion and control over them. Mining income? Taxable. Yield farming? Taxable. Selling NFTs? Capital gains or ordinary income depending on if you created them or just flipped them. Providing liquidity in a DeFi pool, the tokens you receive may be taxable income, and the impermanent loss or gain when you withdraw is a taxable event. Imagine you're actively participating in DeFi, moving assets between protocols, earning yield, and minting NFTs. Each of these interactions creates a complex trail of transactions, often involving many small gas fees which also need to be accounted for. The consequence of ignoring these activities is potentially massive unreported income and an even greater risk of audit, especially as the IRS gains more sophisticated tools to analyze blockchain data. The solution? Even more diligent tracking. Many of the advanced crypto tax software platforms are now building out robust support for DeFi and NFTs, allowing you to connect your wallets and parse these complex transactions. It's not easy, but it's absolutely necessary. So here's the bottom line, my friend. The Crypto Tax Guide 2026 for reporting Coinbase and Robinhood gains isn't just about filling out a form. It's about being proactive, informed, and diligent. The IRS is watching. Your exchanges are reporting. The days of flying under the radar are over. Don't let fear or ignorance lead you into a tax nightmare. Start tracking your transactions now. Seriously, if you haven't already, download your full transaction history from Coinbase, Robinhood, and every other platform you use. Get a crypto tax software. Understand the difference between short-term and long-term gains. Be aware of your cost basis. And if you have any doubts, or if your situation is complex, consult with a qualified tax professional who specializes in cryptocurrency. This is not optional. This is your financial future. Take control of it. You've worked hard for your crypto gains. Don't let a mistake with taxes erase them or cause you unnecessary grief. Act now, protect yourself, and trade with confidence, knowing you're compliant.